we're not that far above the floor at 3,200. You're not that far above 3,000. If we make another 50% move, which I think we could easily do, which is what we did from 2 to 3,000, that takes from 3,000 to 4,500. Well, we're a hell of a lot closer to 3,000 than 4,500. So you should buy it. But of course, the best thing I think to buy of the metals is silver, because silver is still around $32 an ounce, $32.70. Very bullish on silver. I'm bullish on both, but it's because I'm so bullish on gold that I'm even more bullish on silver, because I know eventually if gold keeps going up, silver is going to catch up, not to the price, but it's going to catch up percentage-wise and close that gap. It's not going to be 100 to 1.
Gold prices have found a firm footing following a recent pullback from their all-time highs. After nearing the $3,500 mark, gold dropped sharply below $3,200 in volatile trading, including a rapid intraday sell-off that saw prices fall by over $70 without any major news catalyst. Despite this, gold rebounded strongly, recovering nearly $90 from its lows, indicating that investor demand remains intact. Market commentator and economist Peter Schiff believes this correction marked a bottom, calling $3,000 the new floor for gold, much like $2,000 was in earlier cycles. Schiff argues that in a macro environment dominated by inflation, weakening currencies, and fiscal instability, gold is well positioned to continue its upward trajectory, potentially reaching $4,500 or higher over the next cycle. While gold continues to capture attention, Peter Schiff points to silver as an even more undervalued opportunity. Currently trading around $32.28 per ounce, silver has significantly lagged behind gold's rise. When gold crossed $2,000, silver was above $30, and both held those levels. However, gold has since gained over 50%, while silver has seen only a modest uptick. Schiff emphasizes that this disconnect has widened the gold-to-silver ratio well beyond historical norms. He notes that a return to a 50-to-1 gold-to-silver ratio could lead to a sharp revaluation in silver prices, especially as gold continues to climb. According to Schiff, if investors feel they missed the move in gold, silver offers a second chance to participate in the metals rally. The macroeconomic backdrop further supports both metals. Persistent inflation, rising entitlement liabilities, and negative real interest rates erode confidence in fiat currencies and traditional savings instruments. Schiff has long argued that the deterioration of purchasing power, masked by official CPI metrics, makes precious metals essential for wealth preservation. Gold's status as a monetary anchor drives strong institutional and retail demand, while silver's industrial applications add another layer of value in a weakening global economy. Now, we present the clips from Peter's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The specter of this Bitcoin conference is also probably causing some buying of Bitcoin, because people probably expect that the conference will generate a lot of publicity, a lot of hype. And so people like to buy Bitcoin into that hype so they can sell it. And it's normally a buy the rumor, sell the fact. So maybe we'll get a big dump in Bitcoin, either during or maybe just before the conference. I mean, people may try to, get ahead of it. And they may not even wait for the news to start selling. There could be a sell-off even before the conference begins. But my point was, I think it's significant that the risk appetite is waning. And you can see that, most pronouncedly in Bitcoin, which is the riskiest of all the risk assets. And so if people's appetite for risk is diminishing, you would see it there. Now, of course, while the stock market was rallying and, gold pulled back. Gold had about a 10% pullback. Gold almost got above 3,500. And this morning, it was well below 3,200. In fact, at one point overnight, gold was down about 20 or 30 bucks. And that was following about a $70 decline yesterday in gold. In fact, I was watching gold in the morning and, it was down about $15 or $20. And then over about a 2 or 3 minute period, it got clobbered by like another 50 bucks. No news. Nothing happened. somebody just decided to dump, but, a shitload of gold, at 6 a.m., 6:30, whatever the time was. And the price just got killed. And it pretty much stayed down all day. And then it went down a little bit more last night before it had a big reversal. Gold was up about $60 today, so about $80, $90 off of its low. And so I think today marked the bottom of the gold pullback. So I think it's over. And, gold's now, 3,200 and change. Let me see where it is now, 32.35. And I think the bottom is in. Now, it's possible we can go a little bit lower, but I don't think so. I think 3,000 is the new 2,000. If you remember when gold was above 2,000 initially, and I said 2,000 is the floor, you got to buy it. Well, now 3,000 is the floor. You got to buy it. It's, we're not that far above the floor at 3,200. You're not that far above 3,000. If we make another 50% move, which I think we could easily do, which is what we did from 2 to 3,000, that takes from 3,000 to 4,500. Well, we're a hell of a lot closer to 3,000 than 4,500. So you should buy it. But of course, the best thing I think to buy of the metals is silver, because silver is still around $32 an ounce, $32.70. When gold was at 2,000, silver was about 30. And I remember when silver first got above 30, I said, okay, 30 to silver is 2,000 to gold. And I was right in that silver didn't go back below 30, just like gold didn't go back below 2,000. But then gold went way up and silver didn't. You had a 50% rise in the price of gold, but barely a 10% rise in the price of silver. So if you missed out on $2,000 gold, just buy silver, because as far as silver is concerned, gold is still 2,000. Anyway, you can buy both metals at Schiff Gold. So just go there and fill up your cart or talk to one of my reps. It's not called Schiff Silver, but, maybe I'll have to rename it one day, because I am very bullish on silver. I'm bullish on both, but it's because I'm so bullish on gold that I'm even more bullish on silver, because I know eventually if gold keeps going up, silver is going to catch up, not to the price, but it's going to catch up percentage-wise and close that gap. It's not going to be 100 to 1. At a minimum, my target is 50 to 1. And so at 50 to 1, that means the price of silver doubles relative to the price of gold. But that's not just going to be a double, because the price of gold is going to keep going up. So silver is going to double relative to a gold price that's much higher than the current price. Anyway, we got a quick commercial break. We'll be right back, so stick around. I got more to talk about.
Amid deepening global economic concerns, the US dollar is facing increasing skepticism as its role as the world's reserve currency continues to erode. Escalating trade tensions, rising tariffs, and the growing threat of selective defaults on foreign-held treasury debt have accelerated the trend of de-dollarization. Countries like China, which hold large trade surpluses, are now actively seeking alternatives to holding US assets, viewing the dollar as a potential liability. Peter Schiff has consistently warned that America's weaponization of its currency through sanctions and debt policy would eventually drive the world away from dollar reliance. As Treasury yields approach 5% and bond markets show persistent weakness. Despite stock market rebounds, Schiff sees this as a clear signal that global confidence in the U.S. financial system is deteriorating. Gold and silver are emerging as key safe haven assets in this shifting landscape. Gold's resilience above $3,000 and silver's undervaluation compared to historical norms have reignited investor interest. Peter's message remains clear. Precious metals are essential for preserving purchasing power in a world of rising debt. With long-term interest rates rising and the Federal Reserve constrained by political and fiscal pressures, Schiff argues that the era of easy money is far from over, and that hard assets like gold and silver will become increasingly vital. As investors brace for more volatility and a potential monetary reset, Schiff sees gold and silver as protection and long-term outperformers in a fragile global economy.
You're going to have to pony up more money, which is going to be a problem considering how broke most Americans are and how heavily indebted they are. But trade is not going to completely grind to a halt, which is what the markets were bracing for when the tariffs were 145%, and it was 125% going in the other direction. So the markets had this relief rally, but I think investors are missing out on the big picture here because the tariffs aren't really the problem. I mean, they were a problem, but they're not the problem. The real problem is the trend of de-dollarization and the dollar's status as the world's reserve currency in jeopardy, because we have certainly brought the dollar status to the forefront, I think, in a bigger way than Biden did with the Russia sanctions. I mean, that was certainly a slap in the face, an alarm bell, warning to the rest of the world. Hey, you got to get out of dollars because that is, your vulnerability. To the extent that you're dependent on the dollar, you leave yourself open to U.S. retaliation in the form of sanctions. And so that sent the message that was received loud and clear: hold dollars at your own peril. But I think what Donald Trump has done has really, taken it up quite a few notches by threatening all kinds of tariffs on countries. And, to the extent that you allow yourself to export so much to the United States without importing, and you have these huge trade surpluses, and you therefore are obligated to accumulate dollar assets on foreign holders of our treasuries rather than domestic holders who obviously, can vote and would not be too happy about, not getting their money back. But the Chinese can't vote in our elections. And so I think that this trend is now accelerating to get out of the dollar, and not just the dollar, but dollar denominated assets. So bonds, stocks, and in fact, the stock market has recovered, all of its losses, but not the bond market. On Liberation Day, the yield on a 10-year treasury was under 4%. Today, it's almost 4.5%. In fact, yesterday, it closed at 4.54. We had a bit of a rally today in the treasury market. And so the yields are back below 4.5%, but they're not that far below. We're at 4.44 on a 10-year. So hardly any of the loss has been recovered. Same thing for the 30-year. 30-year was below 4.5, and now it's almost 5. It closed at 4.9. It was, I think, 4.97 yesterday. And so the relief rally in the stock market did not spill over into the bond market. And that is a huge vulnerability, not just for the U.S. economy, but for the stock market rally. Because if the bond market really rolls over, if we break decisively above 4.5 in the yield on the 10-year, which is breaking down. Remember, that's when Trump initially paused the first round of tariffs, not the Chinese pause, but the initial pause. It was because he said the bond market was getting a bit yippy. Well, it's yippy yappy, right? It's still, doing what it was doing. It's just not as quick. It was a sharp collapse back then. But now it's back at the same level. And I think it's getting ready for another sharp collapse. I think the yield on a 10-year treasury can move from 4.5 to 5 very, very quickly. And that's going to be a big problem, especially when Donald Trump has made it clear in his entire administration that one of their main goals is to bring down interest rates. Well, interest rates are going up. And even if Powell caves and cuts short-term interest rates, long-term interest rates are going to rise. After all, they rose after the first few cuts. Why should they not rise if he cuts more? I think the only thing that could temporarily stop the rise in long-term rates is going to be a return to QE.
Gold remains firmly in a long-term bull market, supported by global macroeconomic factors, including rising debt levels, weakening confidence in fiat currencies, and growing central bank demand. Analysts expect prices to exceed $8,000 per ounce over the next several years as the dollar loses purchasing power and inflationary pressures persist. The current pullback in gold prices is broadly seen as a typical correction within an ongoing uptrend. It offers a potential entry point before the market resumes its upward trajectory and likely sets fresh record highs in the coming year. While silver and mining stocks have lagged behind gold's performance so far, they are historically known to outperform in the later stages of precious metals' bull cycles. As investor interest shifts toward undervalued assets with higher upside potential, both silver and mining equities are positioned for substantial gains, with many experts forecasting new all-time highs in the quarters ahead, particularly if real interest rates remain negative and monetary policy turns more accommodative. That's it for today. Share your thoughts on Peter's analysis of silver price suppression in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.